Thanks so much for tuning into Profit Insights. A special episode because we're calling this as the power of 12%. And you might wonder why 12% is so important. Some statistics, viewers. So 12% earned as a compounded annual growth rate number over a period of 6 years doubles your money. You've heard about the rule of 72. Effectively, this is what it leads to. 12% CAGR leads to doubling of money in 6 years. Here's some other math. 1 lakh rupees invested becomes 1.97 lakh rupees in 6 years. 1 lakh becomes nearly 4 lakh rupees in 12 years. And 1 lakh rupees becomes nearly 8 lakh rupees in 18 years. That's nearly 7x your wealth in 18 years with a very conservative return ratio of 12% earned year after year, every year. Impressed enough? Well, if you are, then let's get in our guest to try and understand how do you do this return, predictable return of 12% year after year, every year, because it's not certainly happening via the equity markets. There, the returns may be higher, but the predictability is lower. Frankly, it was his idea, and it's absolute delight to have Hemant Daga, co-founder and CEO of Neo Asset Management, with us in our studios. Hemant, great having you. Thanks for joining in. Let's lay out this this importance of 12%. I mean, why is it that 12% becomes so important? I've given the statistics, but surely you had some thoughts around it.
So Niraj, if you look at this, why did we choose this number 12%, right? Now, there has to be some logic to it. And when you look at the Indian economy, I mean, returns can come to investors only if the underlying assets are generating those returns, correct? The Indian economy has been growing at a real GDP of 6.5 to 7%. And you add inflation to that, which is another 4 to 5%. Typically, when you add 6.5, 7, and you add 4 to 5%, basically you end at a 12% nominal GDP, which India has delivered for maybe 2 decades now. And that is why investors in India are able to take benefits of these 12% returns, right? That is why in a very light-hearted way, we say, 12% to banega, right? And how have investors played this? One of the ways investors have played this out very well is through equity markets. Because that's an asset class people are understanding, more and more people are understanding, and equity markets have delivered. But fundamentally, behind equity markets is this phenomena that our nominal GDP is growing 12%. And if you look at Nifty returns, which is the headline index number, if you slice it over 10 years, 15 years, 20 years, it's ballpark 12 to 14% compounded returns, which is driven by the fundamental strength of the economy, right? But one of the things, when we met, and the other point that I was trying to highlight is, investors look at only equity returns as one of the facets of making this 12%. But there is a beautiful facet which at Neo we want to tell to investors, which we want to propagate, is that there are so many assets in India which are generating cash flows which can generate 12% return. So just like equity markets are delivering returns because there is nominal GDP, you can have other asset classes which can deliver 12% returns to investors if the underlying cash flows are growing at 12%. And that is a business that we love. That is also a business that we love. So there is return on equity, which investors are exposed to, which investors understand. But there is something as simple as return on capital. मैंने पैसे लगाए, ये asset से 12% return छूट रहा क्या उस पे? I think very basic question to be answered. And there are so many assets which generate 12% return on capital in India. An asset which is throwing out return on capital, very predictable, far more stable. Equity markets obviously come with their volatility, but this is a concept. In India, if companies can earn ROE greater than 12, so many assets are earning return on capital of greater than 12%. And that's the power that we want investors to also embrace.
Yeah, most certainly. Now, it's important, viewers, ये समझने के लिए that why is 12% important? Also, aside of the fact that in equities, you probably made 20-25% in a quarter, and therefore it may not look impressive. But the number of investment options available to an Aam Aadmi, the 12% benchmark is crossed by very few.
Yep.
A clutch of fixed deposits, savings deposits, even a public provident fund, for example, don't end up earning 12%. I think it's important to highlight that 12% is nothing to scoff at.
Very true. And I also think I think when you started, when 12% gets compounded over a long period of time, I think in investing, a lot of investing is also staying par on course for long periods of time.
Yeah.
And different investors have different mindsets. What return on capital as a concept does, it gives you far more predictable cash flows. So it's not that your entire portfolio should be there, but some part of your portfolio allocation should be there because that's far more stable, right? So for you staying par on course to earn that 12% is higher degree of chance, right?
Yeah.
I mean, if I'm an equity investor, I entered equity markets in 2008, for example, I can enter equity markets in 2008, post that 6 years, no gratification. Will I continue? Maybe 1 out of 100, maybe 2 out of 100, maybe 3 out of 100, but that number is X people will continue, right? But if you have certain assets which are far more predictable because they are deriving returns from the cash flows, right? And if the cash flows are predictable, I will stay the path. And that is an important part in investing, which I think investors should also appreciate, which is the way humans are wired, right?
Yeah.
Because we are emotional people.
Yes, most certainly.
And the balance in our bank, the profits that we are making influence our investment decisions. It all goes very hand in hand. And hence there is an asset class which can give you 12% compounded, but maybe with less heartaches, with more predictability. And that is a business of return on cash flows.
Exactly. Okay. And therefore, let's try and talk about some of these. So viewers, the idea of doing this just small preamble before getting to the crux was just to make you understand that 12% is an important number. Why is it so important? And the fact that there are multiple ways to earn a predictable 10, 11, 12, 13, whatever, but 12% that we have chosen, 12% rate of return over a period of time to be able to get those predictable returns as well. The portfolio or your portfolio should have a good mix of high risk, high yielding return assets and stable assets which can give you a better than a double digit or lower double digit return, or better than just starting double digit returns. And that's the point out here. So in your, in the presentation that you sent me to study this, right, you've spoken about 3 ways to do this. Briefly take us to them.
Sure. See, fundamentally, the asset has to generate returns, right? In equity markets, the GDP is growing at 12%, which is why equities are generating those returns. So now if you look at the 3 asset classes that we were speaking about, Niraj, very briefly, there are companies which are generating 12% return on capital. And a lot of companies are there in India, right? So if I lend to these companies very conceptually, just imagine you are a corporate generating 12% return on your capital.
मतलब इतना पैसा डाला 12% मिल रहा है
12% मिल रहा है
धंधे से.
ऐसे बहुत सारे धंधे हो गए इंडिया में. And just to give you a statistic to make home the point, there are 65% companies in India earning return on capital greater than 12%.
Got it.
Basically, 100 रुपए धंधे में लगाया, मेरा 12 रुपया तो उस धंधे में बन रहा है, right? Now this is one bucket. Now technically I can find many of these companies. If there are 65% of the companies in India doing this, I can give money to these companies. They can borrow from me. Why will they borrow from me is a separate discussion which we'll have one day. But if they borrow from me, they have the ability to generate those returns. And hence, it becomes a powerful way for us as an investor to earn those returns. So the company requires money. It is already earning 12% greater ROCs, and I'm giving money to earn those returns. So there is one bucket which we call corporates. A lot of corporates are making return on capital greater than 12%. The second bucket, very interesting, all of you have experienced this, right? Which is hard assets. We call this hard assets. You've seen a building, you've taken a building on rent. How much rent would typically people pay? Maybe 8 to 9% rental yield, right? And there is a rental escalation of approximately 3 to 4%. So in total, how much can a fully operating commercial building generate? And we've done this, right? A lot of us take, when we do businesses, we pay rent. When you are taking this place, you are paying rent. So overall, that asset is generating 12% cash flows. 8 to 9% is the contracted yield, 3 to 4% is the price escalation. Now, let me give you one more example. You think of warehouses. large companies, like large e-commerce companies, they are taking large warehouses on rent. How much rental yields would they pay? 7 to 9%, plus there is escalations. Then if you look at something as simple, and Niraj, this is something that we were discussing, an operating road asset, right? Now there is an annuity road which the government of India is encouraging to get built. It's a fully operating asset, it's a hard asset. The government is saying build this road to a developer. It's called an annuity road project. The government of India today on that road project is paying bank rate plus 3%. So the government is paying 9.75% as cash flows. This is return on capital. So the second bucket is hard assets like buildings, hard assets like warehouses, hard assets like operating roads, and the list can continue, right? But if I have access as an investor to a building, I can make those 12% returns because the underlying is generating those 12% returns. So the first bucket is companies generating ROCs greater than 12%. The second bucket is hard assets generating cash flows greater than 12%. Sure. And the third bucket, which is so interesting, just think of it. You are an individual, right? You take a loan against property. And obviously different banks will have different rates, but just to give you an example, you take a loan against property. You would be paying anywhere close to 11 to 12% on it, right? Now finally, that loan against property is also secured by the cash flows that you are earning. What are the cash flows that you are earning? It's effectively your salary stream. Isn't that consistent, right? Because you're living with that. Now I come to you and tell you, Niraj, give me a slice of this. It's a great investment, right? I know Niraj as a counterparty, and he's paying this interest rate on a loan against property. I want to earn that. It's a great. So there is this entire consumption boom in India which is happening, where a lot of retail investors, individuals are paying somewhere close to 12 to 14 to 16%, whether it's a loan against property, right? Whether it is a SME loan. So many people doing SME businesses, they take SME loans at 12, 14, 16%. Credit cards, how much do we get charged? Closer to 30% on credit cards, right? Now, these are all cash flow streams, and there are credit card companies which are listed in the market. So if their mandate is to build a business on it, as an investor, that's for an equity investor. But I just want those cash flows given to me. So now you have three buckets. You have the India consumption bucket, which is based on cash flows of individuals. It's the salary. It's like my salary, your salary, which is the underlying base of it, right? Because we are paying for that. Then you have hard assets, and the third is corporates, because they're delivering those return on capitals, right?
True. So, well, multiple ways to do this. Now, viewers, what we do is we slip into a very quick commercial break. On the other side of the break, we try and ask Hemant about how do you or I as an investor participate in any of these three if we are visibly or fairly impressed with this steady, predictable 12% rate of return. Remember the statistics at the start of the show, viewers, that your 1 lakh or 1 crore, as the case may be, doubles in about 6 years if you earn 12% CAGR. So at this predictability, the money doubles in 6 years. Stay tuned, we'll be right back. Thanks for tuning back to Profit Insights. Now, we're talking about the power of 12% in this episode, and Hemant has spoken extensively about the return on capital that comes in from a business. Hemant, quick 30 seconds, rehash, refresher course, why return on capital is so important?
I think return on cap. So basically, asset classes derive two types of returns. Either you can take equity returns, which is left to the last investor, or the asset is making those returns, right? And what we want to propagate, what we want to tell investors, there are so many assets in India which are generating return on capital greater than 12%.
Right.
And as an investor, I want returns on those cash flows. I want return on capital. I don't want return on equity as an asset class. मेरे को वो asset 12% कमा रहा है ना, मेरे को उसका slice दो.
Perfect.
मुझे वो returns चाहिए, because वो क्या है, predictable है, more certain. And as an investor, I can be in the course for a long period of time.
Perfect. Okay, so the importance of that. Now, how do people bet on something like these? There are three options that you registered. How do people bet in this? Or how does a retail investor sitting out there listening to this bet or invest into some of these options?
Very good. So we discussed 3 buckets, Niraj. I think the first bucket is companies generating return on capital greater than 12%.
Right.
So the easiest way for investors to play this is through credit funds. Now a credit fund can be with a mutual fund, or a credit fund can be through a AIF format. What are credit funds doing? They in turn are lending to companies which are generating greater than 12% ROCE. So when they are lending to companies which are generating greater than 12% ROCE, so it's value additive for the company. So if it is value additive for the company, it will also be good for investors. So retail investors, if they understand, they can give money to credit funds to tap into this huge pool called corporates, because corporates are generating those returns.
Got it.
Right?
Okay.
Now the second bucket.
So let's assume you running a credit fund, so people can invest into your credit fund to do with this.
Absolutely.
Is there a minimum on this?
So see, if you go to a mutual fund, the minimum is what applies to mutual funds. In our AI for a SEBI has prescribed 1 crore as the minimum investors should put.
Okay.
But the good thing is, in a lot of funds, the entire 1 crore is not needed upfront. It's needed over a period of maybe a year and a half. But the good thing is, it's stable cash flows that investors can expect.
Perfect.
Now, the second way, we talked about hard assets as an asset class. I mean, finally, what is earning this 12%? Corporates are earning. Hard assets are earning. I explained buildings earn, warehouses earn, an operating annuity asset earns.
Malls earn. Yeah.
Malls earn, absolutely. The simplest way for investors to play this is, there are already so many listed. You go to a stock exchange, you call your broker, there is already a listed infrastructure vehicle which is called InvIT, which is listed. There is a listed real estate investment trust which owns commercial buildings, that is also listed. And the good thing is, see, finally these vehicles are doing what? Like a company runs a business, a listed InvIT owns transmission lines. The transmission line is generating the 12%. It owns roads, it's generating the 12%. Where will that 12% go? To the investor who buys the listed InvIT. If I invest in a listed REIT, it's owning commercial buildings, it's generating the 12%. Where will that 12% go? To investors who participate in the REIT. And the good thing is, a lot of investors might be knowing, might not be knowing. But these InvITs, these listed InvITs have generated these returns in the last 4 to 5 years. So the proof of the pudding is in the eating.
Got it.
Because the asset is generating the returns, these assets have delivered 12 to 15% returns. The good thing is, out of 12, 9, 10 is predictable. And 2 to 3, 4% is the capital appreciation part of it.
Okay.
So good returns with low volatility.
Got it. So 10% is nearly fixed, and you get whatever 2, 3, 4% depending on how the hard asset itself appreciates over a life cycle.
Absolutely. Because in India, you have inflation, so hard assets are inflated.
Got it. But how does an equity investor get access to that? Oh, that happens via the stock price appreciation, because the stock price and a market
will
wisdom
factor that inflation. Yes.
Got it. Okay.
Right? And the third way was, the entire consumption pool. As individuals, you and me are taking loans. We are taking those loans at interest rates of what? Somebody takes it at 10%, somebody takes it as an SME at maybe 12 to 14%. If I am taking a credit card, maybe I am taking it at 30%. So basically, there are different pools at which you and me are borrowing. We are borrowing against what? Our stable cash flows, which is our salaries, right? And that's one of the most stable form of cash flows. Now, as a retail investor, how can I participate in this? We can buy into securitized debt pool instruments. And I'll just repeat it, securitized debt pool instruments. What is this doing? This is saying, okay, it's very simple. There are 1,000 individuals, so it's very granular. Now, these 1,000 individuals all have gone and taken a loan against property. Now, that loan against property can technically be packaged as a loan. So the cash flows, so you and I are going to pay interest on that. That interest goes to our end investor. It can be done through securitized debt pools of money. And that's another way to play these retail pools of consumption in India.
It can happen through a fund route.
It can happen through a fund. You can go and just buy a securitized debt instrument, even online nowadays. There are online platforms where you can participate in securitized debt pools. So it's like saying, as an investor, I have access to a securitized debt pool, which is inherently earning 12% returns based on the salaries of 1,000 people.
Got it. And where are these platforms? Sorry, I'm not saying that you are recommending these platforms, but as an example so that people can go in and try and research these.
There are several online platforms in India now.
For example?
For example, Grip, Vint Wealth. There are funds like us who will offer these instruments to customers.
Okay.
And in online platforms, you can participate for a very small amount. In funds like us, maybe you can put maybe a larger sum of money once you get very comfortable with that.
Got it. Okay, fine. And you know, so great. So we've kind of crystallized these things, right? The 3 buckets, according to you, which are available, and how to go about investing in these to earn that 12% number that we're talking about. Why? I mean, there has to be a way in which an investor approaches this, because traditionally people have been investing into banks, getting that fixed return. This is a new way of thinking that people need to imbibe, right? You want to elaborate a bit on that before we wrap up the show?
See, basically what I've been talking up till now, all of this was and is being done by banks. Now, until now, Niraj, what were we doing? You and I were giving, so assume 12% is this magical total return that is getting generated. Why is it getting generated? I'm repeating again, because the asset is throwing those returns. Now, when you go and give a fixed deposit to a bank, until now, what you were initially doing, you make 6% on your fixed deposit. The bank, after all the operating expenses, makes 4%, and 2% goes away in expenses. So basically, the 12 has got split as 6% for the investor, which is like a fixed deposit, 4% for the bank for doing all this, and 2% has gone into operating expenses. Now, the other way to do it is, as an investor, you say, no, I don't want to do this fixed deposit. Basically, I give this money to a asset management firm or a online platform. Now, what will that platform do? The return remains the same 12%, right? Now, the platform or the asset management firm in this case will give 9 to 10% to the investor and will keep 1 or 2% as management fees for doing all this hard work, because they are also running a franchise. So basically 1 to 2% becomes the management fees, and 9 to 10% becomes returns for investors.
So what the bank used to keep, a part of it or a large part of it now going back to the investor.
Yes. So now just look at it for the investor. Earlier, it was 6% for the investor. Now it becomes 9 to 10% for the investor. So technically, the investor is making slightly better returns. Now, while he is making those better returns, fundamentally, the nature of the asset remains the same. The bank was giving a loan to a commercial builder. The bank was giving a loan to an SME. Here, the investor is saying, okay, I know this asset manager. I know this online platform. They are also regulated by SEBI. We can trust them. We understand the business they are doing. Let us give money directly to them. If we give money directly to them, then instead of making 6%, we have a chance to making 9 to 10%. But obviously, as all investments, you need to understand the risk, appreciate the risk. But the moot point is, the risk is there because the return is also there. The assets are earning those returns fundamentally. 12% cash flows are getting generated. And hence, it's a very logical way of playing this.
Got it. Well, thanks. Usually people don't pay too much of attention to a 12% number, but it is very important to understand the importance of this. So, I mean, great having you in our studios talking about this. Much appreciate your time today.
My pleasure, Niraj. Thanks a lot.
Now, the pleasure was entirely ours. And viewers, thanks for tuning to yet another episode of Profit Insights.